I think first and foremost, valuation is a bad timing mechanism because it can not make sense for a really long time. So if you use that as your only decision factor, you're probably going to end up disappointed and frustrated. Secondly, I don't disagree that there are parts of the market, particularly some of those big tech names, that are a little frothy. But that doesn't make the rest of growth and the rest of tech guilty by association. There's still opportunity in some of those smaller cap tech names, things like tech services and tech-related companies like fintech that will only grow going forward. Now, to his point about the reopening trade and some of those stocks being back above where they were in 2019, I don't think that that's a terrible thing because earnings are expected to be above where they were in 2019 this year. And you also have to remember the market is looking out 6 to 9 months, and we're expecting, at least on our side, we're expecting GDP to get back to where it was by about the third quarter of this year. That's just the recovery to back where we started. Then the real growth begins, and that's where you see even further growth in that cyclical trade, and you need tech to produce more growth. So I think there's opportunity here. I know that the valuations are high, but I don't think anybody needs to get out of it.
Okay, so you just said something very interesting that made me sort of, think about the next question I wanted to ask. And that was the statement you just made about, earnings are expected to be, right? A lot of things are expected to be. The vaccine is expected to be in a lot of people's arms at some point this year. We are expected to be out and traveling again and doing all of those things that we were doing pre-pandemic. And we were expected to be, Josh, getting back to some form of normal, consuming, spending money, getting out, working, stimulating, things like that. We have a lot to live up to. The market, to Jim Chanos's point, is pricing in an awful lot. An awful lot has to go well in 2021, doesn't it?
So to Jimmy's point, you are seeing a lot of the reopening stocks trading at or above where they were prior to the pandemic. But I've explained this already, which is that a lot of these companies have taken advantage of ultra low financing options, have shored up their balance sheets, have refinanced debt, and as a result, they will emerge from this crisis stronger. And in some cases, investors are rewarding them from that. They've also spent the last year digitally transforming their businesses for the future. And Shake Shack's a really great example of that. The stock made a new record high. It's above where it was prior to the pandemic. They did not sit for the last 11 months saying, oh, gee, it would be so nice if people would come and sit down at one of our tables and eat French fries. They spent the last year building Shack Tracks and setting themselves up for a future of app ordering, et cetera, and delivery. And now they can have their cake and eat it too, because when you get a reopening, all those high traffic areas around their locations will see a return of business people working during the day and/or tourism. Plus, they'll have the benefits of all these digital investments they've made. And it's not just my one stupid little burger stock. Think about thousands of companies that have been forced to do this, very large companies like Target and Walmart accelerating the pace of what they would have done in terms of being ready for a digital future. So I think the market is reflecting the fact that the catastrophe also turned into an opportunity and money got much cheaper, so the earnings power will be there. I want to point this out. I think it's very important. 66% of companies last quarter raised guidance for this year. Typically, that number is 33%. So we've had a doubling in the number of companies giving increased guidance for Q1, which is the quarter we're about to see reports for. And it's not shocking to see valuations where they are when you understand the fact that 90% of the S&P 500's assets are non-hard assets. They're intangibles. They're things like customer data and brand value and network effects. That's 90% of the assets in the S&P 500. In the 1970s, that was 17%. Most of the assets in the S&P 40, 50 years ago were like literally cement plants and piles of iron. The entire economy is transformed, but we're using price-earnings ratio as though it's relevant. So when you hear these bubble calls, understand they've been going on for the last 20 years, and most of it is old men in bow ties who are experts on a previous version of the world that does not now exist. Things have changed radically, and I could find you articles from 2016 where people were saying, oh, the market's 20% overvalued, because the PE was 16, and the prior 10 years, the average PE was 14. Well, if that was your signal to exit stocks, you missed a triple in the NASDAQ, a double in the S&P 500. Who are you listening to? So I think people should not make decisions on valuation. They should make decisions on their own financial plan to decide whether or not they're going to lighten up in stocks, and let the markets do what they will do. You have no control over it, and we don't know how stocks will be valued 6 months from now, a year from now.